What's going on, everybody? Welcome back to the Butterfly Monkey channel. Hopefully these guys are up for another court case. This will be a trust court case also dealing with a business trust that the authorities are trying to hit them with a tax as a partnership. So this court case will show the differences or the attributes that one should not have if they're trying to become a pure trust, for sure, right? So you don't be construed as a different type of entity. This is 1912, so this is a long time before those principles actually come out in Morrissey versus Commissioner. But I like this court case because it goes into detail, like harder detail. They might give you the attributes later, 20 years from, what was that, 23 years later, but they give it to you in detail here. And that's, I think, the better. So this is in Boston, 1912, Moses Williams and others as that are trustees versus the inhabitants of a couple towns. Let me read this head note. But for sure you'll understand the attributes that you shouldn't have, depending on the position, that you appoint yourself in or give yourself or appoint someone else. Like if you're a grantor, want to be a trustee, okay, well, there's certain powers that you shouldn't have because that would constitute as a legal title still, even though you were supposed to give up that power. Or if you're a beneficiary, but you gave yourself enough power that you could control some important aspect of the trust, whether it's the property, the trustees themselves, or whatever. Okay, well, those are powers that are not under any principle of ordinary trust law. So if your goal is to make an ordinary trust, these are, and you're doing business, the aspects of your business could be construed as something else because of those powers. Not the rest of the trust, but for sure the business part. Head notes: tax, assessment, trust, partnership, where the beneficial interest in personal property held by trustees in the shareholders whose shares are represented by transferable certificates on which dividends are paid. The question whether such property is to be assessed for taxation under this code as personal property held under trust or under Section 27 as personal property employed in the business of a partnership. So they're looking to tax them one way or the other, as a trust or as a partnership. And they say depends on the powers and duties of the persons in whom legal title is placed. So who's that? The trustees, right? What powers and duties are they supposed to have? If they have control of the property for the benefit of shareholders, the property is to be assessed to them as trustees. But if they are managing agents subject to the control of shareholders who are associated to get together to carry on a business for their mutual profit, the property is a partnership. The property is partnership property and is to be taxed as such. A certain personal property trust was created by an indenture trust, under which the trustees named held property contributed by the holders of certificates of shares in the trust or bought with money contributed by them. So two ways, right? They got shares because they were the initial investors in the creation of it, so they are grantors, or you purchased into it, which the law sees them as donors, not initial grantors, but donors. The certificates, within a limitation of the right of sale, were transferable. The trustees were to invest and reinvest the fund and to pay the income to the certificate holders, and on the termination of the trust were to divide the trust among the certificate holders. There was no provision for any meeting of the certificate holders, so beneficiaries can't call no meeting. The only act which the indenture empowered the beneficiaries to do was to consent individually to an alteration or amendment of the trust or to a termination of it before the time fixed by its indenture. When any one of these things should be proposed to the trustees by the trustees. Here's the thing too, like this is new to me, right? This power individually. There's a couple court cases that are stating this, that are old court cases, and I don't understand completely why. The difference between, okay, because they're voting on something, right? The only act which the indenture empowered the certificate holders to do was to consent individually, right? It's not at a meeting. It's not where everyone votes all at one time or anything like that, but they're stating it individually. I don't know ultimately what they're describing here in terms of the power itself to be able to vote for an amendment, because that's a significant power that no beneficiary should have. So, like, individually, they shouldn't have no power, and they're looking for consent. I'm guessing unanimous or 75% of all shareholders. I don't know. I don't like it because in 1935, this is detrimental. This is 1912, so in carrying on the trust, the trustees treated gains on changes of investment as additions to the trust fund and not as profits. So if you guys know trust law, they put it as corpus. The income that they were receiving became corpus of the trust instead of staying as income. The indenture declared that it created a trust and not a partnership, and throughout the instrument, the certificate holders were spoken of as the stesicute trustant, which just means beneficiary, held that the instrument created an investment trust and not a partnership, and that accordingly the personal property of the trust must be assessed for taxation under statute 1909. So they got hit as a trust. This was the head notes of this, right? 4 petitions to the Supreme Court under that statute by the trustees of Boston Personal Property Trust. Now, this is a trust that people can read. There's a book out there that has it, right? By Wrightington. What's his first name? His last name is Wrightington, though. It's it's either going to be his 1916 book or his 1922 book, right? And it's just unincorporated associations as a business. What is it? The Doctrine of Unincorporated Associations in the back. It's like an 800-page book, and in the back it has this trust, along with others. In the first 3 cases appealing from refusals of the assessor, respectively, of the town of Milton, the city of Waltham, and the town of Brookline to abate taxes assessed on April 1st, 1911, on personal property held by the petitioners as such trustees alleged to be apportionable under the statute. So the trustees want to get hit under that statute. To beneficiaries or trustees whose places of residence were respectively in Milton, Waltham, and Brookline. And this is on purpose. They're stating these, that the beneficiaries, the trustees whose places of residence, right, this is their domicile, is these 3 places. Like, it's within the state. And in the 4th case, appealing from the refusal of the assessors, well, they're saying beneficiary and trustees, from a refusal of the assessors of the city of Boston to abate taxes upon the full amount of personal property held by the petitioners, as such trustees were assessed to the petitioners on the same date under that statute, on the ground that the property was the personal property of a partnership carried on in Boston. The petitioners were heard together by Quinn J. upon an agreed statement of facts. So there's a whole bunch of stuff that they agreed on, except a few things. So now they're saying a judge. Right? There has to be a controversy. In the cases against the town of Milton, the city of Waltham, and the town of Brookline, the judge found that the petitioners were entitled to the abatements respectively claimed in those cases, and ordered that judgment should be entered accordingly. And in the case against the city of Boston, he found that the petitioners were entitled to no abatement and ordered the judgment should be entered for the respondent. So they're looking to tax them as a partnership. The second one, the third, fourth one, or whatever. At the request of the parties, he reported the cases for determination by this court. The indenture of the trust creating the Boston Personal Property Trust was dated January 10th, 1893. Among the provisions bearing upon the character of the trust were the following. Second, that the trustee shall hold all the funds and property hereinafter called the trust fund, now or hereafter held by or paid to or transferred or conveyed to them or their successors as trustees hereunder in trust for the purposes with the powers and subject to the limitations hereinafter declared for the benefit of the sesquiu trustant, and it is hereby expressly declared that a trust and not a partnership is hereby created, that neither the trustees nor the sesquiu trustant shall ever be personally liable hereunder as partners or otherwise, but for all debts the trustees shall be liable as such to the extent of the trust fund only. In all contracts or instruments creating liability, it shall be expressly stipulated that the sesquiu trustant shall not be liable. Now, the thing is with this, right, with this statement, and this is what's in their indenture, what they wrote down, is under ordinary trust principles, beneficiaries are never held liable. They have no power. That is a principle of trust law. It is when dealing in business, because people are grouping up together, creating an entity, and then being beneficiaries, they write these things in these indentures because they are associating themselves together for a business purpose. So having power and control is still a negative if you are trying to avoid that taxation. So because of this possibility, people, they write this in here. For me, I have learned that this trait, when you give them limited liability, whether it's the trustee or the beneficiary, right? You're giving them an attribute that doesn't belong, right? Because you know that they have powers that they shouldn't have. So this liability, limited liability provision would only apply in the case that they have powers. Otherwise, if they didn't have no powers, the principles of trust law kick in and they're not liable anyway. Right? Now, on the other side, doing this with the trustees, well, under ordinary principles, the trustee is always liable. Right? But they're making it his liability to the extent of the trust fund. Right? That's still limited liability. To me, I don't even have this in my documents. Why? Because I'm introducing an attribute that I'm not supposed to have. Right? And this is limited liability when you have full liability. Yeah. It sucks to say this, but 100% trustees are fully liable under ordinary trust principles. It is this attribute that's corporate that's giving them limited liabilities if you write this in your document. So what's the alternative? Indemnification. That no matter what it is that happens that you get hit with or are liable for, as long as you have done your due diligence and abided by the trust indenture, the trust will indemnify you. But that doesn't mean that the action can't be taken against you in the court of law for whatever liability you have. You still have to produce. Thus, the trust will take care of you afterwards. There's a difference, and it's important to know the difference. It says the fourth, so they're not going in order, so second and then the fourth. The trustee shall have full power and discretion as if absolute owners to invest and reinvest the trust fund, including any surplus and also income in the personal property, including bonds and notes or obligations secured upon real estate, and the decision of the trustees as to what is personal property shall be final. They shall have the like power of investment in the purchase of improvement of real estate in the cities of the United States of America for the purpose of leasing the same amount upon long terms or grounds rents so called, and all real estate so purchased shall be conveyed to them in joint tenancy as trustees hereunder. And you see what they did here? They restricted themselves only to the cities of the United States of America. So like if I wanted to really be a dick as a judge, I would anything that they do outside of a city is void, because you're violating your trust indenture. It only says the cities. Unless, of course, this document has definitions that says the cities of the United States means any motherfucking place, any town, any village, any, whatever. That's the only time that this can be construed as something different. Otherwise, this right here is specific. The trustee shall have the power at any time to borrow money and to pledge as collateral security for such loan any personal property belonging to the trust fund, provided, however, that no loan shall be contracted for that the aggregate amount of such loans outstanding shall not exceed in the judgment of the trustees 25% of the total amount of personal property of the trust fund. So they could, if you have a trust fund that's worth in valuation about $100 grand, they're restricted only to 25 grand. The trustee shall declare dividends from the net income of the trust fund among the Sesticute Trustee quarterly, so 3-4 times a year or sooner, if convenient to the trustees and their discretion and their decision as to the amount of dividends, and as to the using thereof, any portion of the surplus fund shall be final. They may set aside from time to time such portion of the net income as shall be not required for dividends for the surplus, which is okay, right? They decide how much, they decide when, but at minimum 4 times a year. You know what I'm saying? So that's not a bad thing. As long as these trustees are not also beneficiaries, like this right here is a good thing, because it restricts creditors from reaching the funds. But the creditors know they get it at least 4 times. So, but they also saying that they go hold it back, but they're not stating for what purposes. But all they say the surplus fund. 9th, the trustees shall render an account annually or oftener if convenient to them, and shall, upon request, deliver or mail a copy to each of the Sesticute Trust. 10th, any trustee may resign his trust by written instrument signed and sealed by him and acknowledged in the manner prescribed for the acknowledgement of deeds, and such instrument may be recorded in the registry of deeds for the county of Suffolk, or deposit with such depository as trustees shall from time to time select. Now, the key thing to understand here is they're choosing who their depository is. They're choosing to use the registry of deeds. They could easily choose a bank or someone else that could function in that capacity, that holds the document for access to others when needed. That's basically what it is. And the county is the most sufficient way, is because it's just being recorded. But, why they're doing it, because they're doing business, right? Even though it's personal property. The only thing I could think of is because they're doing business. If they weren't doing business, but they have real estate, well, they would have to do it anyway because there's real estate in the trust. But if it's just personal property, they're not doing what's construed as doing business within the state, then, you know what I'm saying, there's no reason to go deposit anything. It's a contract between you and someone else. Until that contract, the activities of the trustee within that contract constitutes some type of recording. Even registration. Of course, I'm against that shit, but you know what I'm saying? It's all depending on your activities, what you're choosing to do with that property. Any vacancy occurring from any cause at any time in the number of the trustees shall be filled by the remaining trustees. 14th, the trustees shall issue a certificate in such form as they shall deem best to each person who shall pay them the sum of $100 or multiple thereof for an interest in the trust fund, but no certificate shall be issued for any less sum than $100 at par value. 15th, the interest represented by the certificates may be transferred on the books of the trustees by the person named thereon or his legal representative upon the surrender of the certificate, and a new certificate shall be issued to the transferee, who shall thereupon become the sesquique trust, but no such interest shall be sold under the holder thereof as should be sold under the holder thereof, including the assignees of insolvency or bankruptcy, or for the benefit of creditors and holders by process of law or otherwise, except as hereinafter stated, shall have the first in writing offered it to the sale of the trustee. So what it is that they're doing, the court ruled that they're transfer certificates. Nowadays, they're not considered transferable certificates because he's putting a restriction on it. They have to, you're not allowed to sell them, and they're only transferable upon us under these criteria. And then you have to offer, since they are allowing them to sell it, right? Whatever they do are able to sell. Oh, my bad. Say when the beneficiary passes away, his administrator, executor, or whatever the hell he has, right? Even the court, like probate, are restricted from doing anything with that property because the property is being governed by other rules or other laws. So they're restricted until when they offer it to the trustees to purchase. That's what this is saying right here, right? But no interest shall be sold until the holder thereof. Oh, it does include the holder. I thought it only meant after he passed, right? Some assignee or something, creditors and whatever. So it's also including him. So they're restricting him from selling it, from doing anything with it, unless they ask for permission first, for the sale from the trustees. Which now, like I said, nowadays, this right here is not construed as transferable anymore. 1935 broke that all down. Who shall, as such trustees, have the option for 10 days after the receipt of such offering of buying the same, and not more than the last preceding appraisal made by them. Such appraisal to be made annually or sooner, as they shall deem best. Interest so purchased by the trustees may be held as part of the trust fund or sold by them at their discretion. So did you catch this right here? They could purchase those shares by the appraisal of what they made, meaning the trustees. Because this trust has a par value of $100 per share, you could break down to what, you know what I'm saying? That's like the appraisal of the property involved. So that's what you're going to be buying them back. But like when you restrict it to where it's at no par value, right? Though that piece of paper is just a piece of paper. It just says that you get the benefit if and when the trustees give you something, right? Like the offer to buy something back at no par value, you're looking to do an exchange for them, because like it's a different class of a certificate. It has no value to them. It just represents property, and that if and when this property ever makes anything, that person gets a chop. But an appraisal is different. You're looking to use that property in business or for credit and stuff like that. So it's like it has a set value to it. Devices by will, distribution of the estates of deceased purpose according to law, and distribution of trust funds among those entitled thereto upon the termination of trust shall not be deemed sales for the purposes thereof. All right, because it's transfers by law. trustees may, with the consent of 3/4 in interest of the sesquiu trustant, alter or add to this declaration or terminate this trust, and if it seems to be judicious to do, they may, with the like consent, convey the trust fund to new or other trustees or to a corporation, being first duly indemnified for any outstanding obligation or liability. Okay, this power here, this is a big power. So, like, I know they say individually above, but this right here can't have this power no more. This is all kinds of shit. To alter and add to the declaration, to terminate it, you know what I'm saying? And then it says, for them, judicious so to do, right? They may with like consent. So that it's like they're getting permission from the beneficiaries. Man, it's not, you don't do that no more. Like, that's death. Why they didn't see this in this court case, I don't know. Like, they don't never show the principle. There's a couple of them too that I wish they showed. Give me another court case, if anything, but they didn't. I'm halfway through this because I'm talking a lot. I still got a good half hour. So this is the opinion by one of the judges, Lauren J. Some of this has already been read. So I'm going to try to blast through this. These are 4 petitions for the abatement of taxes assessed upon the plaintiffs as trustees of the Boston Personal Property Trust. The Boston taxes were assessed on the theory that the property held by the plaintiffs under the trust was partnership property to be assessed under 1909C under that statute. In Boston, where the partnership, if there was a partnership, had its place of business. The other taxes were assessed upon the theory that the property held by the plaintiffs under the trust was held by them as trust property, the income of which was payable to another and was to be assessed under this section of the code, right? So it's the same statute, but under section 23 for trustees, section 27 as a partnership. It has been contended in effect, if not in terms, that what may be its true character. The trust for the purposes of taxation was a partnership. Let's go that again. It has been contended in effect, if not in terms, that whatever may be its true character, the trust for the purposes of taxation was a partnership. So that's what the prosecutors are saying. Doubtless, the legislator might provide that a trust which was not a partnership should be treated as a partnership for the purposes of taxation, right? The intent of the legislator. But it has not done so. What the legislator has done is to provide, 1, that personal property held in trust by an executor, administrator, or trustee, the income of which is payable to another person, shall be assessed to the executor, administrator, or trustee in the city or town in which such other person resides, if within this Commonwealth, and if he resides out of the Commonwealth in a place where the trustees reside. And they're just saying it's taxed to the trustee, to the trust, right? Held in trust, because they say it's taxed to them, right? Payable to another, but taxed to them because they are the legal holders of it, right? It's a contract. Like, that's why you have a lot of court cases. They'll say that trusts are not legal entities, that it's a relationship, because that's what it is. But it's cast. It's a contract cast in trust form. Just like a contract for a partnership is a contract cast in partnership form, right? Which that one has a legal identity too, but again, it's in what context are they construed as that entity? And there's always a context, there's always a purpose, there's always an intent. Like, it doesn't change. Like, where I live off, trustees reside. It says, and partner, it says that, and 2, that partners, whether residing in the same or in different cities or towns, may be jointly taxed under their firm name in the place where their business is carried on, for all the personal property employed in such business, except ships or vessels. That is to say, the legislator has provided that the right to tax property as a trust or as partnership property depends upon the real character of the property taxed. Under these enactments of the legislator, there is no room for holding that property which is in reality not partnership property can be taxed as partnership property. The right to tax property as trust or as partnership property depends on what the character of the property tax really is. Now, what do you think they mean, character of the property? Since they're not talking about the character of the entity, they're talking about character of the property. We proceed to a discussion of the principles on which the question of the true character of the Boston Personal Property Trust depends. Where persons associate themselves together to carry on business for their mutual profit, they are nonetheless partners because, one, their shares in the partnership are represented by certificates which are transferable and transmissionable, and because, two, as a matter of convenience, if not of necessity, in case of transferable or transmissible certificates, the legal title to the partnership property is taken in the name of the third person. The person in whose name the partnership property stands in such a case is perhaps in a sense a trustee, but speaking with accuracy, he is an agent for who the principal's convenience holds the legal title to the principal's property. Now, what did they just say here? Right? And no doubt, if you guys know anything about land trust, like in the one in Illinois, right, this is what they just described. At least number two, maybe not number one, right? But number two, right? The legal title is in a trustee who's acting like an agent because the beneficiary has all these powers. That's why they're calling him an agent, because he's doing the beneficiary's bidding. But here's the catch: they associate themselves together. And they use this concept to hit you as an association too, right? Because it's more than one person who are coming together with funds and so forth. And almost 9 out of 10 times, actually probably 10 out of 10, I haven't seen one yet where there's a beneficiary not having who doesn't have powers that he's not supposed to. Every single one of them, they all got taxed for the reasons they got taxed, all stemmed from the powers that these beneficiaries should not be holding anymore. So take that as however you will for those persons who want to have powers over the trust still, when the whole sole purpose of a trust is to bifurcate title. Several instances in such partnerships are to be bound in our reports. In Hoodley versus County Commissioners, it's a Massachusetts case, one Gordon McKay executed a declaration of trust by which he declared that he held his patents for sewing the soles of boots and soles of the vamps. His factory where machines were manufactured under these patents, and the whole business theretofore carried on by him in trust for persons of as should buy certificates which were to be issued under the declaration of trust to the amount of 50,000 in number, the proceeds to be used in carrying on the factory and the business assigned to and held by the trustees. So the proceeds used to carry on the business. The certificate holders were to be known as the McKay Sewing Machine Association, and the business was to be conducted by an executive committee to be chosen by them. So the beneficiaries choose their committee, right? Which is a no-no. This was held to create a partnership, and for that reason, the shares were held to not to be taxable to the holders of them. For a subsequent case involving the same association where the same conclusion was reached, McGleason versus McKay, another, which in Whitman versus Porter, another Massachusetts case, certain subscribers associated themselves together to buy a ferry boat to be run between Agawam and Springfield. The boat was to be conveyed to one of the subscribers in trust, and the entire business was to be conducted by the trustees and their officers to be annually elected by the subscribers. The stock was assignable. These stockholders held to be partners. And then they give you the parts, right? It was assignable, meaning it's transferable, right? They have powers to what? Choose their officers. They didn't say nothing else here. Pertaining to Whitman and Porter, they didn't say nothing else. All they said is the boat was to be conveyed to one of the subscribers in trust, and the entire business was to be conducted by the trustees and their officers annually, elected by the subscribers, and transferable shares. Like, I see two powers here, and they got hit as partnerships. But again, you got to look at this in the light of in context of a business trust, and they're showing you what is constituting this business trust to be hit as a partnership. So if you do the opposite and not be construed as a partnership, and you're doing some type of a business and you're not a partnership, then what are you? You're an ordinary trust with a business, with a piece of your property used for business. The whole point is the avoidance part. Don't do what these people are doing if you don't want to be hit as a partnership with a business trust. In Phillips versus Blanchford, the money to be carried on the business of manufacturing and selling grapes was raised to the sale of transferable certificates issued under a somewhat similar declaration of trust, which provided that the business should be carried on by the board of managers, of whom the trustees was to be one, and the other members was to be elected by the shareholders. This was also held to be a partnership. So I'm going to skip these because I'm pretty sure you guys are noticing this. Right? Held to be a partnership. In Richter, the certificate holders were declared in the declaration of the trust to be an association, and all the business were to be transacted by the board of managers elected by them. The property of the association was to be held by the American Loan Trust as trustee. This was also held a partnership. In Williams versus Boston, the property of this association was held to be taxable as a partnership. This is the different one. Mayo and Moritz, Massachusetts case. On the other hand, it was held that certificate holders under a declaration of trust were in question were not partners. In that case, an inventor transferred his invention to trustees, to whom, by the terms of the trust indenture, the patent was to be issued when it was issued. The trust indenture provided for the issue of scrip shares, right, to those who should furnish to the trustees money necessary for the more advantageous disposition of the invention. So selling them, right? They don't have distinct kids as beneficiaries or something like that. They're just selling the shit. The trust on which the trustees were to hold the invention and the money produced by the issue of scrip was to hold, manage, and dispose the invention or any part thereof or interest therein upon such term as to them, the trustees, or a majority of them should seem best. The net proceeds to be paid 1/2 to the inventor and the other half to the holders of the scrip certificates. The scrip called in this trust indenture scrip or certificates was transferable. Vacancies in the office of trustee were to be filled by the remaining trustees. It was held that the scrip holders were not partners, and in that respect, the case was unlike Gleason and Phillips above, which is true, right? Even though they were transferable, right, which is a corporate attribute, that attribute alone did not constitute an association, partnership, or something else. At least for this case at this time, since this is before 1935. And Moritz is probably a couple years before this one. I don't think it was probably the same year, probably 2010, 2009. So it's like, what are they saying here? The inventor got half. He never told them nothing else. They don't dictate shit else to them. Because he is a beneficiary, right? He gets 50%. The rest of them split 50%. None of them have any powers. The trustees, when there's vacancies, the beneficiaries have no say-so. The remaining trustees take over. To me, these are important attributes to understand. After listening to this, your first thing should go read Morrissey versus Commissioner, 1935. If you don't even read the whole thing, read the first page, because it gives you the 1 through 10 or 1 through 6 or something like that of the attributes. Understanding what those attributes are is another question for another day too. I try to in my videos, when I can, when the topic comes up. The difference between Hoodley, involving the same indenture as Gleason and McKay, Whitman and Porter, Phillips and Blanche and Richter, and Williams and Boston, on the one hand, and Mayo and Moritz on the other. So he's saying the distinction between the one we just read, the nice one, on the other hand, lies in the fact that in the former cases, meaning the ones that were construed as partnerships, in the former cases, their certificate holders are associated together by the terms of the trust and are the principals whose instructions are to be obeyed by their agent, who for their convenience holds the legal title to their property. The property is their property. They are the masters. While in Mayo versus Moritz, on the other hand, there is no association between the certificate holders. The property is the property of the trustees, and the trustees are the masters. All that the certificate holders in Mayo and Moritz had a right to have the property managed by the trustees for their benefit. They had no right to manage it themselves, nor to instruct the trustees how to manage it for them. As we said it in as was said by C. Allen J. in Mayo, the scrip holders are Sestacute Trust beneficiaries and are entitled to their share of the avails of the property when the same is sold, and that is all to which they were entitled. In Mayo, the scrip holders had the common interest in the trust fund at the same sense that the members of a class of life tenants, right, in a state, the life tenants and the members of the class of remaindermen, which, if people know, right, it's a type of beneficiary. The remainderman only gets property when the trust terminates or gets sold. In some cases, when it gets sold, if it states it, but for sure during termination. Where the rest, the other beneficiaries, would be income beneficiaries because they directly benefit during the life of the trust itself. Among whom the income of the trust fund and the corpus are to be distributed respectively, have a common interest. So he just told them the script holders in the trust, right, in Moritz, all they had was this type of interest. No different than, if you guys understand life tenants and what I just explained about remainderment. Like, this is big to understand here. In Mayo, there was no association among the certificate holders, just as there is no association, although a common interest among the life tenants or remaindermen in an ordinary trust. For a decision in this commonwealth, somewhat like Mayo, see Hussey, it's another Massachusetts case, I haven't read that one. See also in this connection, Macon and Savins Institute at Portland. That's a Maine. So right here, like for, this right here, you want to continue your research to understand cases like Mayo, right, which is a trust, an ordinary trust, even though you know that they were doing business. Why? Because the trustees were selling shares for investment purposes so he can expand his invention ideas. you know what I'm saying? This is where I get my knowledge from. This is where it's important at. How much more to go? A little bit to go. It goes, there is a case in England, Smith versus Anderson, in which the distinction between cases like Hoodley and Mayo was pointed out and established, and that case is now established law in England. In Smith, decided by the Court of Appeals in 1880, the trust deed provided for the purchase by trustees of shares in the capital stock by 11 different submarine telegraph companies. The money was to be furnished by subscribers to whom transferable certificates were to be issued. The income derived from the submarine shares and the proceeds of the sales of them were to be applied by the trustees in 1, paying 6% interest on the trust certificates issued under the trust, 2, in redeeming these trust certificates at £120, and finally, 3, all the certificates have been redeemed. The surplus, if any, was to be divided among the former certificate holders. It was held that this was a trust and not a company, association, or partnership which had to be registered under the Companies Act of 1862. That act provided that no company, association, or partnership shall be formed for the purpose of carrying on any other business, that is to say, any business other than banking, that has for its object the acquisition of gain for the company, association, or partnership, or by the individual members thereof, unless it is registered. This conclusion was reached on the ground that there is a difference between a partnership where money raised by the issue of transferable certificates is to be held by so-called trustees who are really managing agents, and a trust where money raised by the issue of transferable certificates is to be held by trustees properly so-called, and the distinction between the two is that which we have just stated in detail. And this is describing a case that's 32 years before this one, talking about in England. The decision in Smith is the law of England today, although by reason of some special facts in that case and the way in which the question arose, doubts as to the conclusion reached in the case have been thrown out by 2 or 3 individual judges. For subsequent cases, so they're talking about New England, they're not talking about England. They're talking about in New England. That'd be funny if their real name was England before, and then, when they're changing governments, they call it New England. I don't know. Just talking. By the way in which the question arose, the conclusion, the 3 judges knocked it out. Okay, so for subsequent cases, read Crowther v. Torley, in re Siddall, in re Jones, for 2 cases where the distinction between managing agents who hold the legal title and trustees, properly so-called, is reaffirmed. See in re Thomas. Like these right here, I would read these cases. I'm actually going to search these, the ones up here too. This brings us to the question of the character of the Boston Personal Property Trust. It is plain that it is a trust and not a partnership. By the terms of the indenture of trust, the property contributed by the certificate holders, or that bought within money contributed by them, the original trust property could be acquired in both ways by the terms of the indenture of trust. was to be held by the trustees in trust to pay the income to the holders of the certificates, and on the termination of the trust to divide the trust funds or the proceeds thereof among them. The certificate holders are throughout called sesquiu trustants. The certificate holders or beneficiaries are in no way associated together, nor is there any provision in the indenture or trust for any meeting to be held by them. The only act which, under the trust indenture, they can do is to consent to an alteration or amendment of the trust created by the indenture, or to the termination of it before the time fixed of the deed. But they cannot force the trustees to make such alterations. So that's the thing. It's advisory only, right? When they say individual consent, they're saying an advisory role. And that's okay. So now I get it. That's crazy. How I missed this part right here. But they cannot force the trustees to make the alteration, amendment, or termination. It is for the trustees to decide whether they do any of these things. All that the certificate holders or beneficiaries can do is to give or withhold their consent to the trustees taking such action. And the giving or withholding of consent by the sesquiu trust is not to be had in a meeting, but is to be given by them individually. As we have said, no meeting of the beneficiaries for that or any other purpose is provided for in the trust indenture. The trustees of the Boston Personal Property Trust have the right to sell the trust securities and reinvest the proceeds, and also a limited power to borrow on the security of the trust property. And of course, the limited power to borrow is the 25% restriction of the complete value of the trust. The certificate holders, as they are the sesquiu trust, as they so are called in the deed, have a common interest in precisely the same sense as the members of a class of life tenants, among whom the income of the trust fund is to be distributed, have a common interest, but they are not solely associate. I think this means association, right? Socialized together. Let's look. Ask Copilot. Associate. Really? This is using as a reference to make treaties and alliance, which is what we're thinking about, right? What does it mean? I don't know. It's not given to me, though. I know it means something like that to associate, though. And it is the trustees, not the certificate holders, who are the masters of the trust property. The sole right of the sesquiu trust is to have the property administered in their interest by the trustees, who are the masters, to receive the income while the trust lasts, and their share of the corpus when the trust becomes to an end. It has been urged by the learned counsel for the city of Boston that these certificate holders are, in effect, carrying on the business of buying and selling securities through the trustees as managing agents or directors, and he refers to two facts which he argues bears him out in that contention. Namely, one, that the trustees on April 1st had on hand undivided income to the amount of $51,000 and a surplus capital of $488,000. By the terms of the trust, the trustees are authorized to set aside from time to time such portion of the net income as shall not be required for dividends for the surplus fund. So he's putting into that, which surplus fund may be subsequently used by them in their discretion in payment of dividends. It appears that the face value of the outstanding certificates, which is $2 million, the surplus fund of undivided income, for amounts to 2.5% of the corpus of the fund. The surplus capital of $488,000 is about 23.5% of the face value outstanding certificates. That is not an extraordinary increase in the value of a corpus of the trust and fund during a period of 18 years. But this contention brings out a fact in addition to those already referred, which shows that the Boston Personal Property Trust is not a partnership, but a trust and nothing but a trust. When persons engaged as partnerships in buying and selling stock, bonds, and other securities for their mutual profit, the gains made by purchase and sale are profits of the partnership, divisible as such among those entitled to the profits of the partnership. In case of trust, on the other hand, any gain made by a change of investments is an accretion belonging to the corpus of the trust fund and belonging to those who own the corpus of the fund. Such gains become part of the corpus as much as such original money contributed to the trust fund. And that's because they have that provision that the income, all the proceeds become the corpus of the trust, or unless the trustees determine otherwise, which they do for the surplus, right? Which is like a 10% that goes to the shareholders. Such part original money as the trust, and they're telling you, right, that money, when they declare it as the corpus of the trust, it becomes no different than the original. On them, the certificate holders are entitled to income while the trust lasts, and to their share of them, because they are included in the corpus of the trust fund. When the trust ends and there is a distribution of the corpus among the beneficiaries, that is the way in which the trustees of the Boston Personal Property Trust have dealt with gains made by changes of investment of the securities of that trust. That is to say, the trustees have treated gains from sales of securities not as profits of a partnership organized to buy and sell stock for a profit, but as gains on the change made in the investment of the trust fund. It was largely with respect to the gains made by sale of securities of trust that the special circumstances in Smith-Anderson raised a doubt as to that being a trust for investment and not a business that has for its object the acquisition of gain. It was provided in the trust deed in Smith that the submarine telegraph shares should not be sold unless they brought a premium of 30%, and that the proceeds of such sales should be used in the same way that the annual income derived from the submarine telegraph shares should be used, namely in paying interest on the trust certificates and in retiring those certificates at 120 pounds a share. They were issued originally at 90 pounds per share. In that respect, the trust in question in Smith was quite different from the Boston Personal Property Trust. There is nothing in the deed of the Boston Personal Property Trust which is in any way different from a trust under a will, except there are no limitations over the interest of the beneficiaries are represented by transferable and transmissionable certificates. Up to this time, we have not alluded to the declaration in the indenture of the trust here in question that it was the intention of the parties to it to create a trust and not a partnership. It is what the parties did in making the trust indenture that is decisive, which is the substance, right? He's not even going like on their intentions. They didn't even go and seek that. They're looking at all the powers, right? That's the substance of the trust itself. If there had been doubt as to what they did, what they intended to do would have been a matter entitled to some consideration in determining what they did. It was stated in a passing remark made by this court in Williams v. Johnson that in the trust before the court in that case, the certificate holders were partners within the meaning of the word of the statute, Part 1, Section 27, which the trust provided for meetings of the shareholders, and in that respect, for some association of among them, an examination of the original papers show that it was a trust and not a partnership. This remark in no way is essential to the decision of Williams. So they're making a thing here that they had meetings, right? Does the meetings give them powers over anything, right? That's the restrictions that you put. These meetings could be advisory too. And they still construe them as a trust and not a partnership. Because in the end, I swear, it's the powers. It's powers, man. Like, I don't know how else to put that. It's powers. In the Boston Personal Property Trust, the property is the property of the trustees to be managed for the benefit of the certificate holders, but to be managed by the trustees and not by the certificate holders. There is no association of or among the certificate holders. The rights of the certificate holders are limited to each receiving his share of the income of the trust investments during the continuance of the trust and his share of the corpus of the trust when the trust comes to an end. It is in every respect an investment trust and nothing more. It follows, 1, that the property held by the plaintiffs as trustees of the Boston Personal Property Trust was not taxable as a partnership property, and that in the petition brought by them against the city of Boston, they are entitled to an abatement, and 2, that their property was taxable as property held in trust, the income of which it was payable to another, and the taxes assessed by the assessors of the city of Waltham and by the assessors of the inhabitants of Milton and Brookline were properly assessed, and that the petition assessed against those municipalities should be dismissed. It is so ordered. So, hopefully we learned something. If not, I don't know what else to say. But this gives you at least a clue of what certain principles are supposed to be had by just ordinary trust, not to say business trust, right? Because the type of business trust that I like, that I enjoy, are not ones that are associated together, but no doubt it has a business purpose. The question is, what powers are you conferring to those other offices that you created that they're not supposed to have? And the only way for you to make that determination is to learn ordinary trust principles. And for me, how I learned all this stuff, I learned ordinary trust principles by reading business trust court cases like these. And they gave enough information where all I had to do was go to an ordinary trust law book, whatever author you might like, right? Wakeman Scott or whoever, Perry. And that's it. You go find the specific context, the specific attribute that they're speaking on, and you go from there. Hopefully you guys enjoyed this. Hope you guys like and subscribe. Share with others if it was deemed worthy enough. Until the next time, I will try not to make it, such a long span before my next video. Take care and enjoy.